Hi, Steven Van Metre here. Welcome to your Monday night premiere, where we take about 15 minutes every Monday and Wednesday night to try to figure out why investors want to overpay for stocks. I mean, because they are. It's just crazy. Before we jump into all of that, the content of this video provides educational information only. It's not intended to provide investment or other advice. This material is not to be construed as a recommendation or solicitation by security, financial instrument, or participate in particular trading strategies. This video was prepared by Steven Van Metre, personal capacity opinions. The rest of the video that I don't do not reflect the view of Atlas Financial, Inc. or Steven Van Metre Financial. So, highlight of today, we're going to look at how much money the Treasury is going to borrow through the end of the year and completely drain liquidity. And we're also going to take a look at oil company stocks, which are quietly selling off. This is not garnering attention of anyone, but as you know, we've been following it because this is opportunity knocks when prices are cheap. You try to buy high, you're always looking down. You know, when's the floor going to fall? How am I going to get out? People think they can get out of this market fast enough, and wait till they figure out how much this market is computer traded. It's much easier when you buy low to look up. All right, so let's start with liquidity. The NASDAQ McClellan Summation Index really hardly changed since Friday. Still showing liquidity is tight. There were other indicators that I've looked at from other people that are just showing you cannot put large trades in this market right now, or you will be moving the market. Next up, we have U.S. Treasury estimates. Let's go backwards and forwards. So net borrowing, net mean you have to look at the fact that the Treasury has to borrow for the debt that's out there. So as debt matures, some people may just renew that debt. Say, hey, I had a 10-year bond, I'll just take another one. But that debt has to renew. Plus, there's the net. That net is the amount above their recirculated borrowing, new borrowing. So keep that in mind. So he says U.S. Net borrowing April through June, this is 2019, was $40 billion versus prior $30 billion estimates. So they borrowed a little bit more than they thought. Cash balance was $264 billion at the end of June versus $270 prior estimate, meaning the government's spending a little more than they thought, and this should come down to the low 100s. As I predicted, it won't matter because apparently I'm guessing the budget has been passed. I didn't even see it in the news, but the Treasury wouldn't be putting these numbers out if they didn't think that that has happened. Here's where it really gets interesting. Treasury sees $433 billion net borrowing July through September. Well, obviously July's over, so that means they're going to be borrowing a boatload of money. Their prior estimate was $160 billion. Now remember, I said they're going to go after around $300 billion worth of money. There you go. U.S. Treasury estimates $381 billion in net borrowing between October and December. I'll just say this. Good luck with the economy holding through the next 90 days. Good luck. I just don't see there's a chance of it. I'm going to go on a limb thinking we're going to be in a recession within 90 days or less. It usually follows the first rate hike. I had a really strong epiphany of why rate cuts trigger market sell-offs. Why do we get recessions after the Fed cuts rates? You wouldn't think that. But Friday, well, not only will we look at my data, I've got a nice big deep write-up for you that you can take a look at. So let's jump right into the charts. Like I said, I don't have a whole lot to look at today because not much changed from where we were on Friday. The S&P 500 and NASDAQ were down slightly. Dow was up slightly. Russell 2000 down a little bit. Not a big deal. Treasury yields, we could see across the curve. 5-year Treasury yields rejected off their 50-day moving average and went lower, which is what you would expect on a rejection of the 50-day moving average. 10-year Treasury yields didn't hit their 50-day yet, but they're acting like it, and yields went down. And 30-year yield, after being rejected 4 times, 3 for sure, almost 4, adds 50-day moving average, they went down too. Again, that's exactly what you should expect to see. This is telling you, as an investor, that yields are headed lower at the moment. That could change, but that's where we would have it at the moment. Gold prices really didn't do much. They bounced a little bit higher. Everyone's antsy about the Fed meeting, but it's still, this charting pattern actually suggests, based on the volume, which is a little easier to see on the mining stocks. You see all the spike of volume up here. You see mining stocks are not breaking out yet. I still think there's a pullback there, deeply overbought. I mean, too many people piled in too quickly. So you could see volume spike here, kind of came down, and now you're getting a volume spike here. Will this be a little shallow dip and run? Maybe. Or will it be a much bigger pullback that we want to see, confirming these moving averages, the 50 in green, 100 in blue, and the 200-day in tan. But here, let's take a look at oil. Let's start with crude oil. And that's silver. There's crude oil. So crude oil is sitting in a tight range here. It's coiling back and forth. It rejected at its 50-day moving average today after briefly touching just under 56 a barrel. A breakout above this would be bullish. A breakout below would be bearish. Now, tomorrow we get the API report of the American Petroleum Institute. For those of you who don't know what that is, it is a voluntary report. So they just put out and said, what are your inventory levels? There's no requirement to respond. On Wednesday morning, we get the official government report where they are required to respond. And based on what we saw last week with oil dropping due to the Gulf of Mexico area being shut down, and we did not see a big draw in gas or distillates, which suggests we're about to see a crude build. Now, when you look at oil and gas producing stocks, this becomes a little more obvious. So let's go and look up symbol XOP. This is smaller oil and gas producing stocks. We've looked at this in detail, but here you go. As of today, again, we're referencing all the way back to it's December 6th, it's January and then February 16 lows. And look at today. It's quietly traded below its December 2018 lows. So it broke down here. We'll zoom in a second. But just want you to see the low price was roughly around 23. It did get dipped down to 22, but it's right around 23 and starting to slide. Okay, so let's zoom in. What that means is if it breaks this 23, it's a very bearish signal, which suggests that these prices are headed significantly lower. The way you look at that is this is a big giant 2.5 year topping pattern. 2.5 year topping pattern, which suggests that very large investors or corporate insiders have been selling their cash of stock all the way through here. And when this breaks down, you can kind of measure it and say, well, you take 43, which is roughly where the top is, subtract 23, and you get 20, which suggests, just from a chart, and again, I'm not going to say this is actually going to happen, but from a chart perspective, you could think that this is going to be down around $3 a share. Want to talk about a huge buying opportunity going forward? That's where you find it. You find it when no one else wants to buy. You find it when they're selling. So this is looking like it's about to break down. Will the trigger be this week's oil report? Could be. Because we'll get the EIA data on Wednesday morning ahead of the Fed. So will the Fed's data cause it to fall? Will it be more about another week of data? We don't know. But all we know is this chart pattern is saying there's a big sell-off here and big opportunity. Now, my guess is we might see an opportunity in the gold miners pull back first and then go, and then we see this fall to the bottom. I'm not sure which is going to happen first, or maybe the whole market's just going to start to unwind when the Fed starts to cut. There's kind of a reason that happens shortly thereafter. And again, I don't want to spoil Friday unless something better comes up. So let's just wrap things up a little early. We've got the big Fed meeting on Wednesday, so we'll cover that after market close, and you'll have that video Wednesday night, of course, and we'll look at the EIA data. We'll watch the oil company stocks. Things are about to get really, really interesting, and not a lot of people are ready for it because they're all loaded up in stocks. Anyone who's got cash or U.S. Treasury bonds or cash equivalents like those, opportunities coming your way soon. I'm Steve Van Metre. I'll see you Wednesday night. Bye now.